Welcome to this exam review from Birdsy, your AI-powered study partner. Be sure to like and subscribe for more videos, and don't miss what's happening in the lower corner of the screen. It could be just the thing you need to pass your exam. Let's get started.
Let's start with a review of core policy provisions and options. Entire contract, insuring clause, consideration, free look. What is the primary purpose of the insuring clause in an insurance policy? Is it A, to list all policy exclusions? B, to state the insurer's promise to pay benefits? C, to provide details on premium payments? Or D, to outline the policy's free look period? The answer is B, to state the insurer's promise to pay benefits. The insuring clause outlines the insurer's promise to pay benefits under the conditions specified in the policy. What does the consideration clause in an insurance policy typically include? Is it A, premium payment and application? B, policy exclusions? C, insurer's promise to pay? Or D, free look period? The answer is A, premium payment and application. The consideration clause includes the premium payment and the application as the insured's part of the agreement.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is the purpose of the free look period in an insurance policy? Is it A, to extend the coverage period? B, to provide additional benefits? C, to allow policy cancellation for a refund? Or D, to change the policy terms? The answer is C, to allow policy cancellation for a refund. The free look period allows policyholders to review the policy and cancel it for a full refund if they are not satisfied. John receives his new life insurance policy and notices a 10-day free look period. What can he do during this time? Is it A, increase his coverage amount? B, add additional riders? C, file a claim? Or D, cancel the policy for a full refund? The answer is D, cancel the policy for a full refund. During the free look period, John can review the policy and cancel it for a full refund if he is not satisfied. Which part of the insurance policy is considered the entire contract? Is it A, only the policy document? B, policy document and attached riders? C, only the application? Or D, only the insuring clause? The answer is B, policy document and attached riders. Why this question may seem a bit tricky. The entire contract includes the policy document and any attached riders or endorsements, not just the policy document alone. What does the entire contract provision in an insurance policy ensure? Is it A, that the policy can be changed at any time by the insurer? B, that the policy document and attached endorsements form the complete agreement? C, that the insured can cancel the policy at any time without penalty? Or D, that the insurer must provide annual updates to the policy terms? The answer is B, that the policy document and attached endorsements form the complete agreement. The entire contract provision ensures that the policy document, along with any attached endorsements, constitutes the complete agreement between the insurer and the insured. What is typically included in the consideration clause of an insurance policy? Is it A, the policyholder's health status? B, the insurer's financial stability? C, the premium payment and promise of coverage is? Or D, the policy's expiration date? The answer is C, the premium payment and promise of coverage. The consideration clause typically includes the premium payment made by the insured and the promise of coverage by the insurer. What is the primary function of the free look period in an insurance policy? Is it A, to allow the policyholder to review and cancel the policy for a full refund? B, to provide a grace period for late premium payments? C, to enable the insurer to adjust the policy terms? Or D, to extend the policy coverage automatically? The answer is A, to allow the policyholder to review and cancel the policy for a full refund. The free look period allows the policyholder to review the policy and cancel it for a full refund if they are not satisfied. Sarah just received her new health insurance policy. She wants to ensure it meets her needs. What should she do during the free look period? Is it A, file a claim to test the policy's coverage? B, ignore the policy until she needs it? C, request a premium reduction from the insurer? Or D, review the policy and cancel if unsatisfied for a refund? The answer is D, review the policy and cancel if unsatisfied for a refund. During the free look period, Sarah should thoroughly review the policy and, if unsatisfied, she can cancel it for a full refund. In an insurance policy, what does the insuring clause primarily define? Is it A, the policyholder's obligations? B, the insurer's promise to pay for covered losses? C, the exclusions and limitations of the policy? Or D, the policy's renewal terms? The answer is B, the insurer's promise to pay for covered losses. Why this question may seem a bit tricky, the insuring clause specifically outlines the insurer's promise to pay for covered losses, which can be confused with other policy sections.
Finding this exam review helpful? If you haven't already, like and subscribe for more videos that'll get you ready to pass.
Grace period, reinstatement, policy loans withdrawals. What is the typical grace period for a life insurance policy? Is it A, 7 days, B, 31 days, C, 60 days, or D, 90 days? The answer is B, 31 days. The grace period for most life insurance policies is typically 31 days, allowing the policyholder to make a late payment without losing coverage. What happens if a policyholder fails to pay the premium within the grace period? Is it A, the policy remains active without penalty? B, the policyholder receives a refund? C, the policy lapses? Or D, the policy is automatically reinstated, ... The answer is C, the policy lapses. If the premium is not paid within the grace period, the policy typically lapses, meaning coverage is no longer in effect. What is a policy loan in the context of life insurance? Is it A, a loan against the policy's cash value? B, a loan to pay future premiums? C, a loan that increases the death benefit? Or D, a loan that reduces the policy term? The answer is A, a loan against the policy's cash value. A policy loan allows the policyholder to borrow against the cash value of their life insurance policy, often at a favorable interest rate. John's life insurance policy lapsed due to non-payment. He wants to reinstate it. What is typically required for reinstatement? Is it A, pay only the overdue premiums? B, submit a new application, ... C, provide evidence of insurability only? Or D, pay overdue premiums, provide evidence of insurability, and possibly pay interest? The answer is D, pay overdue premiums, provide evidence of insurability, and possibly pay interest. To reinstate a lapsed policy, John usually needs to pay overdue premiums, provide evidence of insurability, and possibly pay interest on overdue amounts. Can a policyholder withdraw funds from a term life insurance policy? Is it A, yes, if the policy has cash value? B, no, term life insurance has no cash value. C, yes, but only after a certain period. Or D, no, unless the policy is converted to whole life. The answer is B, no, term life insurance has no cash value. Why this question may seem a bit tricky. Term life insurance does not accumulate cash value, so withdrawals are not possible, unlike permanent life insurance policies. What is the primary purpose of a grace period in a life insurance policy? Is it A, to provide extra time to pay the premium without losing coverage? B, to allow the insurer to cancel the policy? C, to increase the policy's cash value? Or D, to adjust the policy's death benefit? The answer is A, to provide extra time to pay the premium without losing coverage. The grace period allows the policyholder extra time to pay the premium without losing coverage. This prevents immediate policy lapse due to a missed payment. Sarah's life insurance policy lapsed after she missed a payment. She wants to reinstate it. What might she need to do? Is it A, pay a penalty fee only? B, submit a new application? C, pay back premiums with interest and provide proof of insurability? Or D, wait for the next policy anniversary? The answer is C, pay back premiums with interest and provide proof of insurability. Reinstating a lapsed policy typically requires paying back premiums, interest, and possibly providing proof of insurability. Which of the following is true about policy loans in a whole life insurance policy? Is it A, they reduce the death benefit permanently? B, they do not accrue interest? C, they require repayment within a year? Or D, they are borrowed against the policy's cash value? The answer is D, they are borrowed against the policy's cash value. Why this question may seem a bit tricky. Policy loans can be confusing because they involve borrowing against the policy's cash value, not withdrawing it. Settlement options and death benefit payment. Lump sum, interest, fixed period, fixed amount options. What is the primary advantage of choosing a lump sum settlement option for a life insurance death benefit? Is it A, immediate access to the full amount? B, guaranteed income for life? C, tax-free income? Or D, higher interest earnings? The answer is A, immediate access to the full amount. The lump sum option provides immediate access to the full death benefit amount, allowing beneficiaries to use the funds as needed without delay. Which settlement option involves receiving the death benefit in equal installments over a specified period? Is it A, lump sum? B, interest only? C, fixed period? Or D, fixed amount? The answer is C, fixed period. The fixed period option distributes the death benefit in equal payments over a set period, ensuring regular income for the beneficiary. How does the interest-only settlement option work for life insurance death benefits? Is it A, pays the full benefit immediately? B, pays interest on the death benefit? C, pays equal installments over time? Or D, pays a fixed amount until exhausted? The answer is B, pays interest on the death benefit. The interest-only option pays beneficiaries the interest earned on the death benefit, while the principal remains intact for future distribution. John's life insurance policy offers a fixed amount settlement option. If his beneficiary chooses this, how will the payments be structured? Is it A, one-time full payment? B, interest payments only? C, equal payments over a set period? Or D, regular payments until the benefit is exhausted? The answer is D, regular payments until the benefit is exhausted. The fixed amount option provides regular payments of a specified amount until the entire death benefit is depleted. Which settlement option might appear to provide a guaranteed income but actually depends on the interest rate environment? Is it A, lump sum, B, fixed period, C, interest only, or D, fixed amount? The answer is C, interest only. Why this question may seem a bit tricky: the interest-only option can seem stable, but actual income varies with interest rates, unlike fixed period or amount options. What is the main characteristic of the fixed period settlement option for life insurance death benefits? Is it A, payments are made in a lump sum, B, payments are made in equal installments over a set period, C, payments vary based on interest rates, or D, payments are made until the death benefit is exhausted? The answer is B, payments are made in equal installments over a set period. The fixed period option distributes the death benefit in equal installments over a specified period, ensuring a steady income for the beneficiary. Lisa's life insurance policy offers a fixed amount settlement option. If her beneficiary chooses this, how will the payments be structured? Is it A, a single lump sum payment, B, payments based on current interest rates, C, equal payments over a set period, or D, regular payments of a specified amount until exhausted? The answer is D, regular payments of a specified amount until exhausted. The fixed amount option provides regular payments of a specified amount until the death benefit is fully paid out. Which settlement option might appear to provide a guaranteed income but actually depends on the interest rate environment? Is it A, interest-only option, B, fixed period option, C, fixed amount option, or D, lump sum option? The answer is A, interest-only option. Why this question may seem a bit tricky: the interest-only option can seem stable, but payments fluctuate with interest rates, unlike fixed options. Life income, joint and survivor, life with period certain. What is a life income with period certain settlement option? Is it A, payments for a fixed period only, B, lifetime payments with a guaranteed minimum period, C, payments until the annuitant reaches a certain age, or D, payments that decrease over time? The answer is B, lifetime payments with a guaranteed minimum period. A life income with period certain guarantees payments for the life of the annuitant and a minimum period, ensuring beneficiaries receive payments if the annuitant dies early. How does a joint and survivor life income option work? Is it A, payments stop after the first death, B, payments are made for a fixed period only, C, payments continue until the last survivor dies, or D, payments increase after the first death? The answer is C, payments continue until the last survivor dies. A joint and survivor life income option provides payments for the lifetimes of two individuals, continuing until the last survivor dies. What happens if the annuitant dies before the period certain ends in a life income with period certain option? Is it A, payments continue to the beneficiary, B, payments stop immediately, C, payments are refunded to the estate, or D, payments are reduced by half? The answer is A, payments continue to the beneficiary. If the annuitant dies before the period certain ends, payments continue to the beneficiary for the remainder of the period. John and Mary choose a joint and survivor life income option. If John dies first, what happens to the payments? Is it A, payments stop immediately, B, payments are reduced by half. C. Payments are made to John's estate. Or D. Payments continue to Mary. The answer is D. Payments continue to Mary. In a joint and survivor option, payments continue to the surviving annuitant, Mary, until her death. In a life income with period certain option, what happens if the annuitant outlives the period certain? Is it A. Payments stop after the period certain? B. Payments continue for the annuitant's lifetime? C. Payments are reduced after the period certain? Or D. Payments are made to the beneficiary? The answer is B. Payments continue for the annuitant's lifetime. Why this question may seem a bit tricky, it tests understanding of both components. Payments continue for life, even if the period certain ends. In a joint and survivor life income option, what happens if the primary annuitant dies and the survivor is still alive? Is it A. Payments stop immediately? B. Payments increase for the survivor? C. Payments continue, possibly at a reduced amount? Or D. Payments are transferred to a new annuitant? The answer is C. Payments continue, possibly at a reduced amount. Why this question may seem a bit tricky. The joint and survivor option ensures payments continue to the survivor, but the amount may reduce. It's important to know the terms of the reduction, if any.
Finding this helpful? Hit like and subscribe so you'll be the first to see new exam prep videos on the topics you need to master, all with Birdsy, your AI-powered study partner.
Standard life insurance riders. Waiver of premium, waiver of deductions riders. What is the primary purpose of a waiver of premium rider in a life insurance policy? Is it A. To keep the policy active without premium payments if the insured is disabled? B. To increase the death benefit if the insured becomes disabled? C. To provide a loan against the policy's cash value? Or D. To convert the policy to a paid-up status? The answer is A. To keep the policy active without premium payments if the insured is disabled. The waiver of premium rider ensures that the policy remains in force without requiring premium payments if the insured becomes disabled. Which condition typically triggers the waiver of premium rider? Is it A. The insured's retirement? B. The insured's death? C. The insured's total and permanent disability? Or D. The insured's divorce? The answer is C. The insured's total and permanent disability. A waiver of premium rider is usually triggered by the insured's total and permanent disability. John has a life insurance policy with a waiver of deductions rider. He becomes disabled. What happens to his policy deductions? Is it A. Deductions continue as usual? B. Deductions are waived during his disability? C. Deductions are doubled? Or D. Deductions are refunded? The answer is B. Deductions are waived during his disability. The waiver of deductions rider ensures that policy deductions are waived during the insured's disability, keeping the policy in force. How does a waiver of deductions rider differ from a waiver of premium rider? Is it A. It increases the death benefit? B. It provides a cash payout? C. It covers accidental death? Or D. It waives policy charges instead of premiums? The answer is D. It waives policy charges instead of premiums. The waiver of deductions rider waives policy charges, while the waiver of premium rider waives premium payments. Can a waiver of premium rider be added to any life insurance policy at any time? Is it A. Yes, it can be added at any time? B. No, it must be added at policy issuance or during specific periods? C. Yes, but only if the policyholder is under 50? Or D. No, it can only be added after a claim is made? The answer is B. No, it must be added at policy issuance or during specific periods. Why this question may seem a bit tricky. Riders often have specific eligibility criteria and may not be added after policy issuance. What happens to the premium payments if a policyholder with a waiver of premium rider becomes disabled after the age limit specified in the rider? Is it A, premiums are waived regardless of age? B, premiums must continue to be paid? C, premiums are refunded for the period of disability? Or D, the policy is automatically terminated? The answer is B, premiums must continue to be paid. Why this question may seem a bit tricky. The waiver of premium rider typically has an age limit, often around 60 to 65 years. If the policyholder becomes disabled after this age, the waiver does not apply, and premiums must still be paid. Guaranteed insurability option Payor rider. What does the guaranteed insurability option rider allow a policyholder to do? Is it A, cancel the policy without penalty? B, purchase additional insurance without evidence of insurability? C, reduce premiums during financial hardship? Or D, convert term insurance to whole life insurance? The answer is B, purchase additional insurance without evidence of insurability. The guaranteed insurability option allows a policyholder to purchase additional insurance coverage at specified times without providing evidence of insurability. What is the primary benefit of a Payor rider in a life insurance policy? Is it A, increases the death benefit? B, allows policy loans without interest? C, waives premiums if the payor becomes disabled or dies? Or D, provides a cash payout upon maturity? The answer is C, waives premiums if the payor becomes disabled or dies. The Payor rider ensures that premiums are waived if the payor becomes disabled or dies, maintaining the policy in force. John has a life insurance policy with a guaranteed insurability option. He wants to increase his coverage after getting married. What advantage does this rider offer him? Is it A, increase coverage without medical underwriting? B, lower his existing premiums? C, convert his policy to a different type? Or D, add additional beneficiaries? The answer is A, increase coverage without medical underwriting. The rider allows John to increase his coverage without undergoing medical underwriting, which is beneficial if his health has changed. A Payor rider is often added to a juvenile life insurance policy. What happens if the payor dies or becomes disabled? Is it A, the policy is canceled? B, the insured receives a payout? C, the policy is converted to a paid-up status? Or D, premiums are waived? The answer is D, premiums are waived. Why this question may seem a bit tricky, the focus is on the payer, not the insured. The rider waives premiums, not the policy itself. Accidental death and dismemberment, AD&D rider. What is the primary purpose of an accidental death and dismemberment, AD&D rider in a life insurance policy? Is it A, to provide additional benefits for accidental death or dismemberment? B, to cover all types of death, including natural causes? C, to replace the primary life insurance policy? Or D, to provide coverage for critical illnesses? The answer is A, to provide additional benefits for accidental death or dismemberment. The primary purpose of an AD&D rider is to provide additional benefits in case of death or dismemberment resulting from an accident, supplementing the basic life insurance coverage. John has a life insurance policy with an AD&D rider. He loses a limb in a car accident. What benefit does the AD&D rider provide in this situation? Is it A, no benefit as it only covers death? B, full death benefit payout? C, a specified benefit for dismemberment? Or D, coverage for medical expenses. The answer is C, a specified benefit for dismemberment. The AD&D rider provides a benefit for dismemberment due to an accident, such as losing a limb, which is separate from the death benefit. Does an accidental death and dismemberment AD&D rider cover death due to a heart attack? Is it A, yes, as it is a sudden event? B, no, it only covers accidental events. C, yes, if it occurs while driving. Or D, no, unless specified in the policy. The answer is B, no, it only covers accidental events. Why this question may seem a bit tricky. A heart attack might seem sudden, but it's not considered an accident. The AD&D rider covers only accidents, not medical conditions. Living accelerated benefit riders. Accelerated death benefit, terminal illness riders. What is the primary purpose of an accelerated death benefit rider in a life insurance policy? Is it A, to provide financial support if diagnosed with a terminal illness? B, to increase the overall death benefit? C, to waive premium payments? Or D, to provide a loan against the policy? The answer is A, to provide financial support if diagnosed with a terminal illness. An accelerated death benefit rider allows policyholders to access a portion of their death benefit early if they are diagnosed with a terminal illness, providing financial support during a difficult time. John has a life insurance policy with an accelerated death benefit rider. He is diagnosed with a terminal illness and has 12 months to live. What can John do with this rider? Is it A, increase his policy's death benefit? B, cancel his policy without penalty? C, access a portion of his death benefit early? Or D, transfer his policy to another person? The answer is C, access a portion of his death benefit early. John can use the accelerated death benefit rider to access a portion of his death benefit early, providing him with financial resources during his illness. How does an accelerated death benefit rider affect the remaining death benefit of a life insurance policy? Is it A, it increases the remaining death benefit? B, it has no effect on the remaining death benefit? C, it doubles the remaining death benefit? Or D, it reduces the remaining death benefit? The answer is D, it reduces the remaining death benefit. Why this question may seem a bit tricky, it might be assumed that the death benefit remains unchanged. However, accessing funds early reduces the remaining death benefit available to beneficiaries. Cost of living and return of cash value riders. What is the primary purpose of an accelerated benefit rider in a life insurance policy? Is it A, to increase the death benefit over time? B, to provide funds in case of a terminal illness? C, to return premiums paid if the policy is canceled? Or D, to cover long-term care expenses? The answer is B, to provide funds in case of a terminal illness. An accelerated benefit rider allows policyholders to access a portion of their death benefit early if they are diagnosed with a terminal illness, providing financial support during a critical time. John has a life insurance policy with a cost of living adjustment rider. If inflation increases by 3% this year, how will his policy be affected? Is it A, the premium will decrease by 3%? B, the death benefit will decrease by 3%? C, the death benefit will increase by 3%? Or D, the policy will remain unchanged? The answer is C. The death benefit will increase by 3%. A COLA rider adjusts the policy's death benefit in line with inflation, ensuring the benefit maintains its purchasing power over time. How does a return of cash value rider differ from a standard life insurance policy's cash value feature? Is it A, It pays out both the death benefit and cash value upon death. B. It allows policy loans against the cash value. C. It guarantees a fixed interest rate on cash value. Or D. It reduces the premium if cash value exceeds a certain amount. The answer is A. It pays out both the death benefit and cash value upon death. Why this question may seem a bit tricky. The return of cash value rider specifically provides the cash value to beneficiaries in addition to the death benefit, unlike standard policies where only the death benefit is paid out. Riders in universal, variable, indexed policies. Waiver of monthly deduction in UL. What is the primary purpose of a waiver of monthly deduction rider in a universal life policy? Is it A. to increase the death benefit, B. to cover monthly deductions during disability, C. to provide additional cash value, or D. to reduce the premium payments? The answer is B. to cover monthly deductions during disability. The waiver of monthly deduction rider is designed to cover the monthly deductions from the policy's cash value if the insured becomes disabled, ensuring the policy remains in force. John has a universal life policy with a waiver of monthly deduction rider. He becomes disabled and unable to work. What impact does this have on his policy? Is it A. the policy's monthly deductions are covered during his disability, B. the policy's cash value increases automatically, C. John must pay premiums to maintain the policy, or D. the policy's death benefit is reduced? The answer is A. the policy's monthly deductions are covered during his disability. The waiver of monthly deduction rider ensures that the policy's monthly deductions are covered during John's disability, preventing the policy from lapsing. In a universal life policy, what happens if the insured becomes disabled and has a waiver of monthly deduction rider? Is it A. the premiums are waived entirely, B. the cash value is automatically increased, C. the monthly deductions are waived during disability, or D. the death benefit is increased? The answer is C. the monthly deductions are waived during disability. Why this question may seem a bit tricky. The waiver of monthly deduction rider specifically covers monthly deductions, not premiums or cash value increases, which can be confusing. Index participation, secondary guarantees, variable features. What is the primary purpose of a secondary guarantee in a universal life insurance policy? Is it A. to increase the policy's cash value, B. to provide additional death benefits, C. to keep the policy in force despite low cash value, or D. to reduce premium payments? The answer is C. to keep the policy in force despite low cash value. Secondary guarantees ensure that the policy remains in force even if the cash value is insufficient, provided certain conditions are met. A policyholder with an indexed universal life policy is concerned about market volatility. How does the index participation rate affect their policy's performance? Is it A. it guarantees a minimum return regardless of market conditions, B. it limits the portion of index gains credited to the policy, C. it affects the policy's death benefit directly, or D. it determines the policy's premium payments? The answer is B. It limits the portion of index gains credited to the policy. The index participation rate determines how much of the index's gains are credited to the policy, impacting cash value growth. Scenario and comparison questions. Given a client scenario, which rider or provision fits best? Which rider allows a policyholder to purchase additional insurance at specified times without providing evidence of insurability? Is it A. Guaranteed insurability rider, B. Waiver of premium rider, C. Accidental death rider, Or D, cost of living rider? The answer is A, guaranteed insurability rider. The guaranteed insurability rider allows policyholders to buy additional coverage at predetermined intervals without proving insurability. Which provision allows a policyholder to receive a portion of the death benefit early if diagnosed with a terminal illness? Is it A, waiver of premium, B, accelerated death benefit, C, return of premium, or D, guaranteed insurability? The answer is B, accelerated death benefit. The accelerated death benefit provision allows early access to death benefits if the insured is terminally ill. A client wants to ensure their life insurance policy remains active even if they become disabled and can't pay premiums. Which rider should they consider? Is it A, accidental death rider, B, cost of living rider, C, waiver of premium rider, or D, guaranteed insurability rider? The answer is C, waiver of premium rider. The waiver of premium rider ensures the policy stays active by waiving premiums if the policyholder becomes disabled. Which rider provides additional coverage if the insured dies in an accident, but not from natural causes? Is it A, waiver of premium rider, B, guaranteed insurability rider, C, accelerated death benefit, or D, accidental death rider? The answer is D, accidental death rider. Why this question may seem a bit tricky, the accidental death rider only covers accidental deaths, which can be confused with general death benefits. Which rider adjusts the death benefit based on changes in the Consumer Price Index? Is it A, accidental death rider, B, cost of living rider, C, waiver of premium rider, or D, guaranteed insurability rider? The answer is B, cost of living rider. The cost of living rider adjusts the death benefit to keep pace with inflation as measured by the Consumer Price Index. Which rider allows a policyholder to increase their coverage amount without undergoing a medical exam, typically at certain life events? Is it A, guaranteed insurability rider, B, waiver of premium rider, C, accidental death benefit rider, or D, cost of living rider? The answer is A, guaranteed insurability rider. The guaranteed insurability rider allows policyholders to increase their coverage at specified times without a medical exam, often during life events like marriage or childbirth. A client is concerned about the impact of inflation on their life insurance policy's death benefit. Which rider should they consider to address this concern? Is it A, waiver of premium rider, B, accidental death benefit rider, C, guaranteed insurability rider, or D, cost of living rider? The answer is D, cost of living rider. The cost of living rider adjusts the death benefit based on inflation, helping to maintain its purchasing power over time. Which rider allows a policyholder to receive a portion of their life insurance death benefit early if they become terminally ill? Is it A, waiver of premium rider, B, accidental death benefit rider, C, accelerated death benefit rider, or D, guaranteed insurability rider? The answer is C, accelerated death benefit rider. The accelerated death benefit rider allows policyholders to access a portion of the death benefit early if diagnosed with a terminal illness. Which rider is most suitable for someone who wants to ensure their policy remains active if they become disabled and can't pay premiums? Is it A, accidental death benefit rider, B, waiver of premium rider, C, cost of living rider, or D, guaranteed insurability rider? The answer is B, Waiver of premium rider. Why this question may seem a bit tricky. The waiver of premium rider is often confused with other riders that offer financial benefits, but it specifically ensures the policy stays active by waiving premiums during disability.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.